Welcome back. Here we are, another Beers with Rich. I'm Rich. Surprise, surprise, the editor here at Under the Radar Report. Well, it's been another big week, a huge week in fact. I hope you're all coping. Well, in order to cope, we all know what my coping mechanism is. Let's bring it on. This week's beer, Melbourne Manhattan. Two places I won't be going to anytime soon except via this beer. Here it is. I think it's obviously a Victorian beer by Temple Brewing Co. They've thrown the book at it, literally, the gospel. Aged, soaked in whiskey from the gospel. Amber ale. Let's try it on. Well, it's doing something, that's for sure. It's not bad, actually. I'll come back to you later on the full verdict. Well, so far so good. Well, why put my beer down when it seemed like yesterday I was toasting BHP? This week it's that little Aussie battler, Andrew Twiggy Forrest, and his baby, Fortescue Metals. Well, his baby's growing, that's for sure. BHP made 17 billion US, Fortescue 10.3 billion. And that's at the bottom line. You know, that's in 12 months. I mean, I've mentioned Fortescue in the past, but one of the big things that I've always been impressed by with Fortescue is it's got a small cap mentality. I mean, it's not very often that can happen, but it happens more often than not in founder sort of led companies, which are like a real avenue of focus for many investors. Certainly we've done pretty well out of them, like including Macquarie Telecoms, like to name another one. But these people are psychologically wedded to their companies. You know, they don't issue capital. They focus on keeping the company strong by growth and maintaining their balance sheet. They think about the long term, because like basically Twiggy's not thinking, about the next bonus period. He's thinking about the next 20 years. Like, and on that note, you know, he's hitting the green credentials, or Fortescue's hitting their green credentials, like, you know, pretty hard. And that's not just from a PR move. I know there's a lot of PR around green, but it's like it makes economic sense. I mean, Twiggy is against the carbon tax. We all know that. I mean, that was evident in his protesting. He doesn't want to pay it, so he won't be paying it. He certainly won't be paying the European carbon tax if FMG's plans for carbon neutrality in less than 10 years' time come to fruition. But the bigger point to make here is that right now, you know, the market's paying up for growth. I mean, blind Freddy could see that. So anyway, before we get to that bigger point, let's have another toast to the Twigmeister, which we still view as good value. I mean, we released our report today in the blue chip, which is well worth the read. But, you know, it's been a huge week because the results have all now come in pretty much. And everywhere I'm hearing, wow, it's better than expected. Wow, it's better than expected. But you have to remember that those expectations were somewhere between the toilet and the dunny. Companies manage down expectations. You know, companies are good at things like that. Well, they're getting much better at things like communication, and they manage down expectations, and lo and behold, you know, they've exceeded them. Which brings me to my next point. Is there too much optimism in the investment world? I mean, having been in the markets for some time now, I know that people in the markets, like brokers, fund managers, they're optimistic by default. They're normally optimistic people. Like, credit analysts don't generally go that well. Why? Because it's a different mindset from the accounting mindset, who are looking for errors. Markets reward risk, so it's worth taking. It's worth looking at the positives more than it's worth dwelling on the negatives. I mean, that's as a general assumption. But risk is something we see everywhere now. Like, risk is all pervasive in this kind of delta-ridden, lockdown-ridden economy that certainly Australia is going through. But, we're seeing unemployment climbing. We're seeing consumers increasingly cautious. Like there's a lot of nervousness out there. But one thing trumps all this, people. So there is something that trumps everything. Looser for longer. What am I talking about? Interest rates. I'm talking about the taps are not going to get turned off anytime soon. We're going to see low interest rates are here to stay, at least for the foreseeable future. That's what the bond markets say, and that's what's going to happen with Delta remaining an issue. Whether companies outperform expectations is much less important compared to the fact that COVID and lockdowns and Delta are going to keep the taps being turned on. Like Jay Powell might talk up tapering at Jackson Holes, but that's nothing compared to like the actions that they're taking, which is the continued bond buying. So, he's to Twiggy, he's worth a lot more because he's looked after himself in dividends, and we all know that looking after yourself with dividends can never be a bad thing. But what I'd like to turn to is opportunities to make money in what we call the recovery stocks. Because recovery, has occurred in some stocks more than others. But it's not like some linear thing where it's the same for all companies. When the governments intervene in economies, it creates all sorts of dystopian realities. So you have to be wary that just because some stocks have taken off, like it's the Grand National, it doesn't mean that that's the same for all companies. Indeed, in our market, in small caps in particular, there are companies that have been left behind and that haven't taken off, and that's where we're seeing value. In particular, in this week's report, we focus on a few in healthcare. And, hospitals haven't reopened, and they're certainly not about to reopen tomorrow. But when they do, companies that have, big demand for their products are going to be big beneficiaries. So ones like a nurse call system company called Osco that I've looked at. I mean, it's very thinly traded, so you have to be very careful. But they do have a great system that enables really, these hospitals to pinpoint what patients need at any given time. So like they've been around for a long time. Their technology's at the forefront of the world. They've got, international exposure. And in particular in the US, it's just a matter of time before this sort of, this sales book that they've got becomes a reality and boosts their bottom line. And then there's the medical distribution company, Paragon Care. Well, this was for a long time a turnaround. And now, and just when it started getting a turnaround, the turnaround started working with new management, bang, we go into lockdown. So this company is another big beneficiary of hospitals opening up. I mean, these people are a big player in a small market. They've got a great niche in a very fragmented space. So like if you're an international medical technology manufacturer, you use these guys because you're going to get the broadest coverage. And then if by any chance you take back that, you think, oh, we want to do it themselves, they just go to the competitor and say, okay, fine, and then take up the competitor's product. But what I'm talking about are these sort of companies are in the position that Nanosonics was in, which I just mentioned a couple of weeks ago, when they had that huge bumper result in the second half. And we saw that the demand being translated to growth, to actual profit. And that's what we're talking about here. Like another one that's actually reacted from just prior to the lockdown in June. And, the share price has really sort of been weak in the past few months, is People Infrastructure. These guys are a recruitment services group, very, very well run. But, they manage nurses contracts and IT and industrial services. So quite broad based. And we looked at their results and we were really encouraged by the resilience of their earnings, but it's not factored into their share price. And we all know that there is demand in those sort of areas. There's demand for nurses, there's demand for industrial services, there's demand for IT. So often what makes common sense in share markets, but it's not translated, you dig it a little deeper and you think, well, okay, maybe there's, worth putting a few bucks into that stock. And then, finally we come to that problem child. retail foods. Well, this was the belle of the ball, and then it was suddenly ditched after it just pushed that franchise model too far, and now it's well positioned. It's finally come the full circle. Well, not the full circle because it is in the middle of that restructure, but it is well positioned. I mean, people are gagging to go out, and this company's a big beneficiary when they do a retail services. I mean, I'm one of them. I know. I mean, so many of us are, but this kind of company can make big headwind because they've used COVID, they've used all this restructuring to whittle their cost base down. So there's great opportunities to really make profit growth. So what's coming up? Well, next week's exciting because we're going to be focusing on nickel, which is really a hot commodity at the moment, benefiting from battery demand as well as increasing stainless steel production. So that's really one to watch out for. So, we'll be looking at different nickel stocks. We've got our favourites, of course. We've got loads of sub picks coming your way, subscriber picks. So keep writing in because we love hearing from you and looking at new stocks that sometimes we haven't heard of before and running the ruler over them. And then there's a research rundown where we go through all 110 stocks that we cover. So and then we go through the best buys. We have a look at the best buys. So there's a lot to look forward to. Stay happy, stay positive, and just remember, here's to you.